This segment sponsored by Foster Financial. Welcome back to Women's Wealth Wednesday, where we give you holistic financial advice from Foster Financial. And joining me today is their Vice President, Caleb Doane. Good morning, Caleb.
Good morning.
How's it going?
It's going well. How are you doing?
Good. Doing well. Okay, so today we're going to talk about insurance and just really what it means for people to have insurance prior to that qualifying age to be able to get Medicare,
yeah, you got it.
Yeah, so break that down for us.
Yeah, so specifically health insurance, of course. So, I mean, one of the biggest thing that somebody loses when they retire outside of their paycheck, of course, is oftentimes their health insurance.
Right.
And so when you're 65, you can, of course, get on Medicare, which you've been paying into for many, many years while you were working. But the question is, what if somebody wants to retire prior to 65? And it's a situation we often see where husband and wife both want to retire prior to 65, but they're just kind of worried about what to do for insurance until they hit that 65 age. Or another circumstance is maybe a husband plans to retire at 65 and his wife is maybe a stay-at-home mom or just on his health insurance and she's younger. So if he retires at 65, she's only 62, you have to plan for private health insurance for her for a few years as well. So I think a lot of people, they work with a financial advisor because they want to target that early retirement, but then it can be daunting to have to plan for that private health insurance, and that's where we can step in and help. Yeah,
because the market just feels so big and wide, and it's like, what direction do you go in? Okay, so what is the first step when someone is considering getting private health insurance, and how soon should they do it prior to retirement?
Right, so there's a few main options for getting private health insurance. Probably the most common one is a marketplace plan through the Affordable Care Act. And what people might not realize is that you can get subsidized health insurance through this plan if your income is low enough on paper, okay? So it doesn't necessarily mean we can't spend any money like in the years leading up to 65. We certainly can. We just need it to not show up as taxable income on your taxes. And so what we'll do as financial advisors, the way that we help is that we strategically build up a bucket of after-tax or tax-free funds prior to retirement, oftentimes using a Roth account, Roth conversions, things like that, so that in those years leading up to 65, we pull money from the Roth account. It doesn't show up as taxable income. Therefore, your income looks low on paper. Therefore, you get really discounted health insurance.
Okay, interesting. Okay, so, and that's really the strategy there is not having too much income to put you in a certain bracket, because once you're locked in that insurance bracket, it pretty much stays there, at least for that term that you've committed to. Is that correct?
Yeah, I mean, if you only have pre-tax money built up in retirement and you need, $80,000 a year to live off of, if everything's in pre-tax money, the only option you have is to pull out $80,000 from your IRA, and then all of that's going to show up as taxable income, and it's going to make it more difficult to get discounted health insurance.
So when you do get that private insurance through your marketplace, is that insurance tax deductible? Because I know you're saying like you utilizing or pre-taxed money to show your income. But sometimes there's a subsidy that you can utilize for your taxes to say you've paid your own. Does that apply in this case?
Yeah, typically when people are not itemizing, usually what they're paying for those health insurance premiums are not something that ends up being tax deductible. And so it's much better to just plan ahead, be able to get that after-tax bucket of money, that Roth bucket of money built up, so that we can just avoid some of those insurance premiums in the first place. And so if we do that, I mean, there's times where clients are saving $500, $600, $700 a month on health insurance premiums by getting a subsidy just because they're pulling money from a Roth account. And the issue that we see is if people don't plan ahead for this, a lot of times all of their money is in the pre-tax bucket, and therefore they're getting forced to pay taxes on it and then have that higher health insurance premium.
Okay, so it's all about landing that subsidy at that moment. Okay, but I do have a question, a little curveball question for you, Caleb. What if over the years that people are building towards retirement, they utilize an HSA fund, that health savings account fund, and they have funds there that they have not used. And I know we talked strong about you have to apply that to something medical.
Right.
Are they able to take those funds and use it to pay for private health?
That's a good question. So it's kind of a two-part answer. If you're on COBRA, so that's like continuation of benefits. If you're on COBRA, you can use HSA funds toward COBRA. You can't typically use HSA funds towards premiums for any other health insurance plan, like a marketplace plan. You can use, I think it's HRA funds, health retirement or health. Maybe it's health retirement account. HRA funds can usually be used for health insurance premiums. HSA funds typically can't unless it's a COBRA plan, which are typically very expensive. And so usually we don't have people go on COBRA for very long. But if you do have money on an HSA plan, you can use that money towards any other out-of-pocket expenses. So if you're paying out-of-pocket for prescriptions or everything that you're buying at CVS, a lot of times we're using the HSA for that, even if it can't be used towards the marketplace plan premiums.
Interesting. Yeah. All right. Well, you always got the answer, even when I surprise you with a question.
Yeah, absolutely.
Okay, so last question is there a certain time frame that someone needs to start planning for this retirement, getting that private health, trying to do all this stuff?
Yeah.
Because, last time we talked about it's never too late.
Right.
Is it too late sometimes?
Yeah, so I mean, again, I'd say it's never too late, but of course the earlier that you start, typically the more money we can save you on those health insurance premiums. So if somebody comes to us 1 year before they're retiring and says, hey, I need to plan for this private health insurance, there are things we can do, but of course it would have been better to start a little earlier, maybe do more Roth conversions, maybe be able to do conversions in a lower tax bracket. And so the earlier that somebody comes to us, the longer lead time we have, typically the more money we can save you in retirement.
All right, awesome. Thank you, Caleb.
Yep. And the HRA is health reimbursement account. I just remember, not health retirement account. So yeah, there's a little difference between those two.
Okay, wonderful. Thank you for that great information.
Yeah, thank you.
And if you would like more information about Foster Financial, we'll have their website and their phone number listed below. Give them a call, and I'll see you after the break.
This segment sponsored by Foster Financial.